Are you absolutely sure you're not overpaying the IRS in retirement? And what if I told you there are 11 different ways to collect income in retirement, completely tax-free, that most retirees overlook? We're talking strategies that could save you tens of thousands of dollars over your lifetime. And today, I'm gonna show you exactly what those 11 tax-free income sources are, how they work, and the pitfalls to avoid. So let's get started. So picture this, you're newly retired thinking life is good until April 15th rolls around and suddenly you're writing a check to Uncle Sam the size of a luxury vacation. But guess what? With all the tax laws and IRS exemptions, there are plenty of ways to keep more of your hard-earned money in your pocket if you plan correctly. Now to make it simple, I'm grouping these 11 tax-free income sources into 7 categories. We have plenty to cover, but by the end, you'll have a whole new perspective on retirement tax planning. Now let's start with insurance and inheritance. These tend to be the sources of big one-time or monthly checks that can sneak under the tax radar. So if you get hurt on the job or become disabled, workers' compensation benefits are generally tax-free. Also, if you have a private disability insurance policy you paid the premiums on, those benefit checks are typically not taxed. But here's the catch. Social Security disability benefits may be taxed depending on your income level. So you might be thinking, well, disability is disability, right? Not exactly. So if you're relying on workers' comp or a private disability policy, you'll likely be in the clear, but always double check with a pro to avoid mixing it up with Social Security disability rules, especially pertaining to state-specific rules, which many states are different. Now, let's talk about life insurance proceeds. This is one of the oldest tax breaks in the book. If someone names you as a beneficiary on a life insurance policy, the payouts you receive are generally not considered taxable income. But where retirees can slip up is when policies have cash value or they get surrendered early, and those gains can be taxable if not handled properly. So if your goal is to leave a hefty tax-free legacy for your loved ones, life insurance remains a powerful tool. Just be sure to structure the policy with an expert so you don't trigger unexpected taxation. Now, inheritances themselves typically pass tax-free to the heir, at least speaking federally, if the estate's total value is under the federal estate tax exemption, which is currently over $13 million per individual, though it's scheduled to drop in 2026. Now you might be asking, but what if I'm gifting money right now instead of at my passing? And that's a great question. In 2025, you can generally give up to $19,000 to any number of people each year without triggering gift taxes. So for a married couple, that's $38,000 per recipient. But remember, the giver might file a gift tax return if they exceed those annual limits, but the receiver doesn't have to pay taxes on the gift. That's key for grandparents helping kids or grandkids with tuition, home down payments, and the like. Now, this next group might surprise you if you're helping relatives or if you're still working part-time and furthering your education. Scholarships for you or a dependent generally aren't taxed as long as they're used for qualified expenses like tuition or textbooks. But what if your employer foots the bill for a professional degree? Under certain IRS guidelines, your employer can provide up to $5,250 in tax-free education assistance per year. So if you're transitioning into a semi-retirement role and your employer offers to pay for advanced training, that money doesn't usually show up on your taxable income. Just confirm the program you're enrolled in meets IRS criteria. Now, those who adopt or become foster parents often receive government or agency payments to offset the child's expenses, and these payments are generally excluded from taxable income. Sometimes there's confusion if a foster parent receives stipends or additional benefits, and some worry about accidentally crossing income thresholds. So if you're adopting or fostering, keep records of all those payments and confirm with your tax pro that each is truly exempt. But typically these stipends are meant for the child's care and aren't taxable to you. Now, child support has always been tax-free for the recipient and non-deductible for the payer. Meanwhile, alimony used to be tax-deductible for the payer and taxable to the recipient, but that all changed in 2019. Today, under the new rules for divorces finalized after 2018, alimony is not taxable for the recipient nor deductible by the payer, and that's a huge change. So if you're receiving post-2018 alimony, that's more tax-free income in your pocket. So keep your divorce agreement details on file because the date it was finalized really matters. Now, moving on to healthcare savings, one of the most powerful but often misunderstood tools in retirement tax planning. If you have a qualifying high deductible healthcare plan, an HSA lets you contribute funds pre-tax, grows them tax-free, and then withdraw them tax-free for medical expenses. But not everyone can open an HSA, especially if you're on Medicare or a non-high deductible healthcare plan. And if you withdraw for non-medical expenses under age 65, you'll get slapped with penalties. So here's a potential strategy. If you're still a few years away from Medicare, consider maximizing your HSA contributions now and let that money grow, maybe even invest it. Then in retirement, those medical distributions can come out tax-free. Next, let's talk about government and employer relief, the stuff we hope you never have to rely on, but it might come in handy. So if your region is declared a federal disaster area, like after a major hurricane, wildfire, or floods, the government often provides relief funds. And people in crisis sometimes worry, is this extra money going to push me into a higher tax bracket? But in most cases, federal disaster relief is not taxed. But keep documentation of what you receive and confirm the type of aid. But again, typically the IRS says something like, you've been through enough, here's some help, and it's tax-free. And lastly, even if you're partially retired and doing consulting work, certain employer-paid benefits like group life insurance up to $50,000 or certain fringe benefits can be tax-free. But you need to watch for the caps. For instance, group term life insurance coverage over $50,000 might create taxable income for you. So definitely check your employer benefits package if they pay for educational courses, certain meals, or commuter benefits. That's often money in your pocket that doesn't appear as taxable wages. Now let's talk real estate, one of the biggest sources of wealth for retirees. So if you sell your primary residence after owning and living in it at least 2 out of the last 5 years, you can exclude up to $250,000 of capital gains if you're single, or $500,000 of capital gains if you're married filing jointly. But it's not always that simple. If you moved recently or rented out part of the home, you might have to prorate that exclusion. And for a typical homeowner who's lived in the same house for many years, you can often pocket a substantial gain tax-free. That's a huge win if you're downsizing in retirement. Now, I've saved one of the biggest opportunities to stay in a low tax bracket for last, so let's dig into it: investment income. Yes, there is a 0% bracket for long-term capital gains and qualified dividends if your taxable income is below a certain threshold. Now, for a married couple in 2025, that threshold is roughly $96,700 of taxable income. But it's not just about being low income. You could strategically structure your income to generate $100,000 of retirement income while paying 0 federal tax and keeping your taxable income in the 0% long-term capital gain zone, something I'll be showing you how to do at the end of this video. But another important topic for retirees are bonds. When you buy municipal bonds issued by your state or certain localities, the interest is often exempt from federal and sometimes state tax as well. But a word of caution, municipal interest can affect the taxation of Social Security or trigger the alternative minimum tax if you're in a high income bracket. And that's why we analyze our clients' tax returns each year to ensure we're helping them not only invest wisely, but also investing for a high after-tax return on their money. Now, we can't discuss tax-free retirement income without the heavyweight champion, Roth IRAs. Now, contributions to Roth accounts are after tax, but the growth and qualified withdrawals, such as after age 59 and a half and satisfying the 5-year rule, are 100% tax-free. In addition, there are no required minimum distributions, and you can even pass the money to heirs tax-free. There's also a special rule that allows you to withdraw your Roth IRA contributions at any time for any reason, penalty-free, regardless of age. So combine a Roth IRA with HSA savings, municipal bonds, and the 0% long-term capital gains bracket, and you've got a strong shot at significantly reducing your overall tax burden. So those are the 11 ways to have tax-free income in retirement. But don't forget, combining these wisely can exponentially increase your tax savings. The real magic is in working them together so you don't accidentally trigger other taxes like IRMA surcharges for Medicare or taxation of your Social Security benefits. But now it's time to get practical. You're probably wondering, how do I piece this all together to create a reliable retirement income and pay zero tax on potentially six figures? As promised earlier, that's why I put together a video showing you exactly how to structure $100,000 of retirement income tax-free. If you want to see that step-by-step blueprint, click right here on the screen or in the description below to watch that video next. Thanks for watching. If you found this video helpful, please drop a like and consider subscribing to the channel. And if you're interested in scheduling a time to talk with someone on our team, you can visit our website at onedegreeadvisors.com.